Welcome back, everyone. It is Tuesday, September 26th. This is NYU Grads Daily Podcast. Appreciate you coming back. We're going to have a very long episode today, lots to cover. I think I'm going to talk about Taylor Swift and Travis Kelce for the next 40 minutes. I'm just kidding. But yeah, if you haven't heard, those two have had a budding romance, and if not for anything else, I think Taylor Swift is a remarkable marketer and promoter because she's everywhere right now, and this news has taken over all of media. I've never seen Taylor Swift on sports news, but she's all over ESPN and Barstool Sports, a arena that she's never really been on. And with her world tour and world movie regarding the tour, she's just hitting on all cylinders. And slow clap for Travis Kelce. He has scored a billionaire. I mean, yeah, he makes his own money. He makes millions. But compared to her, he could be... It's no different than if he worked at Burger King, right? It's no different whether he makes 20 million or 2 million or 20,000 a year, next to the wealth that Taylor Swift generates globally. So shout out to Travis Kelce. Wow, that is some grab. I digress. Hope everyone is having a great Tuesday. This market, as I have been warning, has been losing traction and has been deteriorating daily underneath the hood if you follow breadth like I do every day. I have a strange feeling that today's action was not a panic. I know it's not a panic sell-off because I look at breadth and it tells me that. But I have a strange feeling that Wall Street is paging Mr. Powell for his speech on Thursday. And they're basically warning him that, hey, you work for us, buddy. And you better not be hawkish longer. And you better start flirting with cutting rates next year in 2024 or else. Because I honestly don't see how a lot of these corporations who have revolving debt that comes due starting now all the way through 2025 can survive a 5 to 6 to 7% Fed funds rate. I just don't see how they will survive, because if you have revolving credit debt right now that's at 3% and you're unprofitable, and you have to pay payroll, your bills, everything to keep the lights on, and you have to roll that over at 5-6%, you won't be you can't sustain the lights. You can't pay your employees, you can't pay your vendors, you can't hire. It's the opposite, right? You got to start cutting back, you got to start laying people off. You have to stop investing in future growth of your business. And I think this is what this is. I think this is a FU to the Fed and a warning to the Fed. If you don't reverse course soon, we're going to see lower prices in stocks. But we'll see. I could be completely wrong, but we shall see. Let's dive into the numbers here. Today's breath was horrible, just like yesterday's was. But we had 58 new highs, 756 new lows. 20% were advancing, 76% were declining. Yesterday's session on Monday, we ended the day on Monday with 79% below the 50-day moving average on the NYSE, the Amex, and Nasdaq. On the close of Tuesday, September 26th, we now have 81% below the 50-day moving average. So we're chipping away. We're getting to this point where we're very oversold. Okay, we have long-term trend lines on the S&P and Nasdaq and all the indices dating back to the November low, the trend line, and we're approaching those trend lines. And those trend lines also correspond with the 200-day moving averages. So we are logically in a place where someone presses the panic button on Apple, on Nvidia, on Microsoft. Microsoft looks really bad. On Meta, on Tesla, saying panic, panic. They're undervalued. We have to buy. Tell all your clients to buy. Institutional and mom and pop. It's a logical place for defense now. So, why am I saying this? Right? It's logical, it's obvious. And if it happens, great. Right? That's a natural thing that should happen. And we can potentially expect a short-term bounce and maybe, possibly go up to retest the 50-day moving average. That is textbook normal behavior. So this is not rocket science. I'm not that smart. Any textbook will tell you this if you read William O'Neill or any textbook. But the reason I'm pointing all this out is if this does not happen, if we go to that 200-day moving average and test it for like a day or two and we break and we go lower, then the market is telling us of worser things to come. So that's kind of the context of the markets right now. We are right there at the trend lines, the long-term November trend line on the SPY. That coincides roughly about 423. We closed at like 425 or something like that today. Let me just check the chart. So we're right there. We're literally a fart away from it. We closed at 426, okay? The 200-day moving average is at 415 on the SPY. So between now and Jerome Powell's speech or speaking event Thursday at 4 p.m., we can easily test 416. That's the 200-day moving average. It's really about what happens when we get there. Let's see. What else can I talk to you about today? Looking at some charts here. All the industries are red. Okay. What led to the downside were utilities, which kind of was bouncing before, but it is breaking down from a much larger pattern. Real estate was the second biggest loser. Makes sense, right? Finally, it makes sense with higher yields, higher rates, higher mortgages, no buyers. Consumer cyclical was third place in the biggest loser. And runner-up was, they did not medal, but runner-up was technology. So those were the leading sectors to the downside, but every sector was red. And when I look at the heat map of the most important companies, I see AMGN, Gilead, Mondelez, green. Everything else was red. So that was kind of your day. Keep watching yields. Keep watching oil and energy prices. One stock that didn't do much today, but is on my radar, it should be on yours as well, is a healthcare pharma company called ABBV. The ticker symbol is ABBV. Apple Boy Victor. This stock is basically been trading in a range since 2021 between like 170 and 130, just bouncing back and forth like Pong, the video game. However, if you zoom in to, let's say, what date was this? Like early September, like September 12th to today. It has been coiled, trading between 152 and 155. So over since basically September 12th to September 26th, it has been trading in a 2.5 point range. If you back up a little bit further back, it's just stair-stepping higher. So back in 2017 to 2020, there was a lot of mergers and acquisitions. It kind of rallied, fell, rallied, fell, rallied. It was in that, 50 to 90 range. Then we broke out of that range looking for a new balance area, and now we found it. This new balance area of like 130 to 165. If we break out of this tight range of 152 to 155 to the upside, what's likely going to happen is that we are going to test 160-ish, like 157. Watch for prices. Are we going to get rejected there, as we have been back in February, March? We got rejected of last year, of 2022. Then we got rejected twice back in December of 2022. And then we got rejected again at January of 2023. Then we got rejected at April of 2023. See if it gets rejected by that trend line. If we don't get rejected and it breaks out of that range, that trend line, we are potentially going to be heading to who knows, because it'll be lifetime highs. But we may be heading to like 180, 190 bucks. Just looking at the chart. So put that on your radar. They're not a fly-by-night company. I'm not giving you horrible advice looking at this company, okay? They own Humira. They own Botox. And Botox is a cash business. You can't claim insurance on Botox. And you can take Botox for headaches, migraines, etc. They are a cash cow. And they pay a dividend. But I'm more interested in what happens here if it breaks out of this 160 range. I have no position. I'm mostly on the short side of many things right now. But this company looks like it might be going higher. I don't know why. What else stuck out today? The end of the day, it tried to rally in the last like 15 minutes. The indices, sorry. And whenever I see that, I go back to the breadth charts, the actual up-down and the up-down volume. And the up-down volume was showing me that the downside selling volume was accelerating into that little ramp. So I knew something was wrong. Either the volume of breadth was lying to me and it was going to jump back up to the upside, or that rally was just going to fizzle out and not materialize. And that's what happened, the latter. That's really about it. What was strong today? Travis Kelce and his stock, right? He is now the top 5 jersey seller in the NFL. He's gained over 300,000 plus social media followers. So he's winning right now. Volatility is up. Gilead and AMGN, as I mentioned, were green. Weak. Everything was weak outside of that. What to watch? Jerome Powell speaks Thursday at 4 p.m. Watch the Magnificent Seven. Oil and energy prices. Watch yields. Not just the 10-year, but watch the 10-year, watch the 2. And that's really it. I know I sound like a broken record, but this works. And if you've listened to my show every day, you know this works. And hopefully, as you've been following along, you as well can now start to get a sense of reading the tape and starting to understand the pulse of the markets and how interconnected everything is. If you have received value or entertainment from my Substack or podcast, I highly and gracefully ask you to subscribe. It helps the algorithms and it helps my ego a little bit. And if you know someone that you think might benefit in your family or your friends, please share it. It would mean the world to me. There is a referral program. Eventually, I am going to put up a paywall, and you can earn credits of free months of the subscription. So thank you again. I will see you guys after the Wednesday session. Later.